BlackRock is a financial behemoth that touches nearly every part of the global economy. But how did it grow to this scale? It all began in the late 1980s when Larry Fink, a young investment banker with a keen understanding of risk, co-founded the company under Blackstone. His vision was simple yet revolutionary: prioritize risk management at a time when few others did. This approach, coupled with the creation of the game-changing Aladdin software, set BlackRock on a path to unprecedented growth. Today, with over $9 trillion in assets under management, BlackRock's influence stretches across industries, nations, and financial markets. But with such power comes intense scrutiny. Here's the story of how BlackRock became one of the most influential financial firms in the world, and the questions its dominance raises. BlackRock's roots trace back to 1988, when Larry Fink, along with co-founders such as Barbara Novick, Ralph Schlosstein, and Robert Capito, started the firm under the umbrella of the Blackstone Investment Group. Fink brought with him lessons learned during his tenure at First Boston, where he had been a rising star in fixed-income trading and an early proponent of mortgage-backed securities. However, a major miscalculation in 1986 that cost First Boston millions taught Fink a painful yet valuable lesson about the importance of risk management. A lesson that would shape his career and the very DNA of BlackRock. Fink's commitment to building a company centered around risk management was bold at a time when many firms prioritized returns without sufficient consideration for potential losses. BlackRock's transparent approach soon attracted a loyal clientele that valued the firm's focus on stability in an unpredictable market. This focus became the cornerstone of BlackRock's philosophy. Success was built not just on capturing profits, but on protecting investments through calculated, data-driven strategies. A pivotal moment in BlackRock's development was the creation of Aladdin, Asset, Liability, Debt, and Derivative Investment Network, a proprietary software system designed to assess and manage financial risk. Aladdin was developed with the goal of providing comprehensive insight into investment portfolios by simulating various scenarios and forecasting potential outcomes. By leveraging vast data sets and sophisticated algorithms, Aladdin offered predictive capabilities that were unmatched at the time. Aladdin wasn't just a tool, it was a game-changer for the investment industry. It allowed BlackRock to scale its operations, managing trillions in assets while maintaining a keen focus on risk management. The software became so effective that other financial institutions began using it, turning Aladdin into a revenue-generating product in itself and extending BlackRock's influence far beyond its direct investments. The reliance on Aladdin helped cement BlackRock's reputation as a forward-thinking firm that integrated technology seamlessly into its operations. The system's ability to analyze millions of data points, perform stress tests, and run advanced simulations provided unparalleled insight into market dynamics. This innovation not only safeguarded BlackRock's investments, but also bolstered client trust by demonstrating the firm's commitment to transparency and careful strategy. By positioning itself at the intersection of finance and technology, BlackRock set a new standard for asset management. The 1999 IPO was a pivotal moment that propelled BlackRock into the public sphere. The capital raised allowed the firm to expand rapidly, enabling it to make strategic moves that would solidify its status as a financial giant. One such move was the acquisition of Merrill Lynch Investment Management in 2006. This acquisition not only added significant assets to BlackRock's portfolio, but also enhanced its expertise in global asset management, allowing the company to cater to an even broader client base. However, The most transformative acquisition came in 2009, in the aftermath of the financial crisis. BlackRock purchased Barclays Global Investors, BGI, a deal that brought the iShares brand under its umbrella. iShares was already a leader in the growing market of ETFs, exchange-traded funds, which provided investors with a low-cost, diversified way to access the market. The move positioned BlackRock as the preeminent player in the ETF space, which was rapidly gaining popularity as a tool for both institutional and retail investors. ETFs were more than just an innovative product. They represented a shift in how people approached investing. Traditional mutual funds, while useful, came with higher fees and less flexibility compared to ETFs. iShares' robust lineup allowed BlackRock to offer products that catered to a variety of investment goals, from income generation to global diversification. The acquisition of iShares proved to be a masterstroke, enabling BlackRock to capitalize on the shift towards passive investing. By aligning with this trend, BlackRock not only grew its assets under management, but also established itself as a market leader, pushing competitors to catch up and redefining the landscape of modern investing. ETFs became a central part of BlackRock's growth strategy. These investment funds, which trade on stock exchanges much like individual stocks, offered a combination of diversification and liquidity that appealed to a wide range of investors. ETFs allowed investors to build balanced portfolios with ease, providing access to different sectors and markets without the higher costs associated with actively managed funds. BlackRock's dominance in the ETF space was reinforced by the success of the iShares brand. With options tailored to various themes and investment strategies, iShares ETFs attracted not only large-scale institutional investors, but also everyday retail traders looking to diversify their portfolios. By charging low fees, BlackRock was able to draw in an even wider client base, creating a cycle of growth that continued to build on itself. The impact of ETFs on the investment world cannot be overstated. These funds democratized investing, making it easier for individuals to participate in the market and achieve diversification with a smaller initial investment. This shift fueled the popularity of passive investing, where funds aim to replicate the performance of a market index rather than attempting to outperform it. BlackRock's leadership in this area ensured its role as a pivotal player in financial markets around the globe. Managing over $9 trillion in assets gives BlackRock significant sway not only in financial markets, but also in corporate boardrooms. This immense pool of assets is spread across a diverse array of industries, from tech and healthcare to energy and consumer goods. With such holdings, BlackRock often holds substantial voting power in shareholder meetings, giving it a voice in how companies are run and the policies they adopt. BlackRock's influence extends to public and private sectors alike. The firm manages investments for sovereign wealth funds and engages in private equity projects, impacting economic growth and stability across multiple regions. This dual role as both an investor and an advisor puts BlackRock in a unique position to shape investment trends and corporate strategies worldwide. Critics, however, have questioned whether one company should have such influence. The concern is that BlackRock's power might skew corporate governance and market competition. The firm's sway over public companies has led to debates about the balance of power in the financial sector and the potential risks of having a single entity wield so much control. BlackRock's reputation as a reliable asset manager has positioned it as a trusted partner to government institutions during financial crises. This was evident in 2008, when the Federal Reserve turned to BlackRock to help manage the distressed assets of Bear Stearns and AIG. The firm's expertise in risk management made it a natural choice for navigating such high-stakes situations. This partnership was not a one-time occurrence. During the COVID-19 pandemic in 2020, the Federal Reserve once again called on BlackRock to manage large-scale bond-buying programs aimed at stabilizing the market. These programs involved trillions of dollars in asset purchases, demonstrating the trust placed in BlackRock's ability to handle complex financial operations. However, these partnerships have also brought scrutiny. Critics argue that BlackRock's closeness to government institutions raises potential conflicts of interest, especially given its dual role as both a public service provider and a profit-driven firm. The perception of a private company managing such significant public funds and programs has led to calls for greater oversight and transparency. Under Larry Fink's leadership, BlackRock made a significant pivot toward prioritizing ESG, environmental, social, and governance practices. Fink's annual letters to CEOs became a platform for promoting the idea that companies should go beyond profit and consider their societal impact. This push was based on the belief that sustainable and ethical practices contribute to long-term value creation and align with the shifting expectations of investors and consumers. BlackRock used its considerable voting power to push for transparency and responsibility in corporate governance. It encouraged companies to disclose their environmental impact, adapt to a low-carbon economy, and embrace diversity. This shift was not without controversy. While supporters viewed it as a necessary step in aligning financial goals with social responsibility, critics accused BlackRock of greenwashing, presenting an image of sustainability without making meaningful changes to its investment practices. The debate over BlackRock's ESG efforts has sparked conversations in boardrooms, among policymakers, and with the public. On one hand, BlackRock's influence has pressured companies to adopt more transparent and responsible practices. On the other, its continued investments in industries with high carbon emissions have drawn accusations of hypocrisy. This duality has fueled questions about whether BlackRock's ESG initiatives are driven by genuine concern or strategic branding. BlackRock's massive influence hasn't come without its share of challenges. Experts and critics alike have raised concerns about the power the company holds over markets and corporate decisions. With its significant voting rights, BlackRock has a say in how major companies operate, which has led some to question whether a single firm should have that kind of reach. The firm's close ties to government bodies, particularly in times of crisis, have also come under scrutiny. While these partnerships highlight BlackRock's reliability, they raise questions about the line between public service and private interest. This ongoing debate points to the need for more transparency and balanced oversight. Even with these criticisms, BlackRock remains a leader in finance. It has changed how investment management works and pushed new ideas into the mainstream. But whether this influence is positive or poses risks to the financial system is still a topic that sparks debate. If you enjoyed this video and want to learn more about stories that shape the world of finance, be sure to like the video and subscribe to our channel. We cover financial news, market trends, and insights on powerful players in the industry. Share your thoughts in the comments. Do you think BlackRock's power is a good thing, or should we be concerned? We'd love to hear from you.